Good morning, everyone. Tim Nyland here. Today is Wednesday, March 10th, and this is our weekly strategy call for Zacks Professional Services. Each week, we focus in on what's moving the market. If you have a specific topic you'd like me to explore in a future video, please leave me a comment below. You can check out previous strategy calls on our channel, and you'll also find many more videos on investing and making the most of Zacks Pro platforms. And don't forget to hit the subscribe button below to make sure you never miss any of our future calls. Today, we're going to discuss the Zacks Earnings Certain portfolio and specifically some of the work that I've begun doing for the Q1 2021 membership review. And I'm going to walk you through some of my thoughts to date on what's going on specifically with the FY1, FY2, and FY3 forecasts. This is obviously mission critical because it is these EPS forecasts that are the lifeblood of stock valuations. So we're going to look at the entire ECP family, and we're also going to look at the Tilt portfolio. So let's go ahead and get started. Very first chart, and again, I utilize the composite facility within the Zacks Research System to replicate the composite proxies for the earnings certain portfolios. Specifically, what you're looking at here, ticker symbol ZECPE, is the 75 stock core earnings certain portfolio. So this is the larger earnings certain portfolio of 75 stocks where the Admiral and the Dividend Aristocrats portfolios are derived from. And the very first thing I would like everyone to note is obviously here's our little COVID correction, and you can see the nice performance we've experienced, and we've more or less flatlined here as the cyclical rotation has more or less gained footing, but we have not collapsed and obviously have not participated in anything related to the NASDAQ sell-off as of late, which is really good. So steady as she goes, as they say, which is great. Same thing with our earnings trajectory. In effect, everything as expected. And when I'm looking at the forecast growth trajectory, specifically in Q1 every year, this is really, really challenging because the bulk of the companies in the earnings certain portfolio are fiscal year end 12 companies, and all of the estimates shift for annual estimates. So we get this noise factor out here for what we call FY3, which is now 2023. And I've got a big red box around this. And you can see that 3% growth rate. So what I promised in prior webinars is to actually kind of explain this phenomenon a little bit more. And as we obviously move throughout the year, that FY3 number will clean itself up. But you'll see what's going on here in just a minute as we go through it. This is totally normal, and we're going to dig into it just a little bit here. But at any rate, 9% trajectory for 2021, 10% EPS growth trajectory for 2022. Remember, we strive for anywhere between 9 and 11% in this portfolio, so we're literally right on target. And one of the things that is obviously so great about the earnings certain family of portfolios is the byproduct of this reliability in earnings, specifically the earnings estimate revisions that literally come through on the positive side each month, almost like clockwork. So what we're looking at in this particular chart is the FY1 and FY2 EPS estimate revision history for the ECP 75 stock core equity portfolio. And what I really want everyone to pay attention to is the FY1 chart, so the upper panel. When we start looking at FY2, remember that the bulk of the companies in the earnings certain family are fiscal 12 companies that just reported their annual numbers, so their fourth quarter. And what that does is it prompts a shift from all the FY3 estimates to FY2. FY2 goes to FY1. And when that happens, we end up actually showing the estimate history for FY3, which can be very sparse, which is why you see that numbers down here a little bit more random than the steady trend of upward revisions that you see in FY1. This will straighten itself out as we move through the year and as some of these older FY3 points that have rolled into FY2 start dropping off. So we really want to pay attention to these upper charts. And I want everybody to see this nice revision trend. We hit the bottom of the COVID revision crisis here in May of last year, and it's just been this steady upward climb. And this is the beautiful thing about the earnings certain family of portfolios. This is what you expect, and this is what we have, and this is what we want. Okay, so just a nice steady climb all the way from 751 all the way to now $8.25. Okay. So what I promised everyone in the prior webinar was that we dig a little bit deeper into some of the causes for this 3% growth rate. I actually received a couple of emails from Zacks Research System users saying, hey, Tim, is there any reason why we should be concerned about this? And my response was absolutely not. And to that question and my answer, I'm going to show you why. So let's begin working through this. One of the reasons why is that when we experience companies that have had a run up in growth in a particular year, in this case, Amerisource healthcare company went from 8% growth to 16% growth. When we start talking about normalized earnings trends, remember that if you experience acceleration in one year, if that growth rate normalizes out, if we go to 16%, then you would expect normalization to be much less than that in 2023. The trend rate overall is around 8 or 9% for both years. It's just that we got 16% in one year, 3% in 2023. So that trajectory still remains intact. The other thing that I want everybody to notice here is that because, again, Amerisource fiscal year end September, still a pretty recent shift. We've got 3 analysts now contributing for FY3. We just don't get a whole lot of analyst contribution for FY3. So FY3 needs to kind of be taken with a grain of salt anyway. You'll see we dropped from 7 and 8 analysts all the way down to 3. So totally to be expected, but this is one of the cases that I wanted to call your attention to. The other case that I want to bring your attention to is the logistics company C.H. Robinson. This company, obviously, a fiscal December. So we rolled FY3 into 2, FY2 rolled into FY1 when fourth quarter reported. You can see that we have 12 analysts contributing for both FY1 and FY2, and we've only got 1 analyst contributing for FY3, and it's negative 14%. It's really difficult when we're doing the kind of work that we're doing to call one analyst a consensus, so I pretty much just ignore this FY3 number. I expect that number to get cleaned up as more analysts begin to report that FY3 number at some point throughout the year. The next scenario, as we look to reconcile that 3% growth rate, is scenarios like Clorox and I believe Quest Diagnostics that we're going to look at next, where we actually get growth that is pulled forward. And everybody remembers the rage of Clorox demand over the COVID crisis. And you can see how the earnings just absolutely accelerated through 2020. Obviously, Clorox an Admiral portfolio member as well. And we were actually able to grow earnings through COVID with members like this. But the downfall to that is that we get, obviously, that demand pulled forward, and then we trough out a little bit, and then we start resuming some sort of normalized trend. We're getting all that with Clorox, as well as only 3 analysts contributing for FY3. So again, we got to kind of take that with a grain of salt. Quest Diagnostics was the other one that I mentioned, same exact thing. Obviously, testing was huge for Quest. We're going to normalize out. We're actually going to go negative 30% expected in 2022 as the testing kind of subsides, and then we start tracking a normalized trend rate again. But again, excellent earnings stability with Quest to be expected. Just a little bit more challenging here through the COVID crisis, trying to manage the portfolios and make sure that everything is behaving as expected. And again, so far, so good. I believe this is the final case when we're looking at this reconciliation. We've got a lot of companies like TJ Maxx. I think Ross Stores is another one. We've got McDonald's. We've got Starbucks. I'm just showing you kind of an example here with just one. And TJ's was one where they literally just reported Fiscal year end January, we've already done the shift. So 2022 is FY1 now. No surprise that this quickly only one analyst reporting FY3, and it's only 1% growth. Is it anything to worry about? No. Again, it's not necessarily consensus. It's a brand new estimate, most likely. And I expect these numbers to clean up as the year progresses. So just one of those things that's more, again, a challenge this time of year as these fourth quarters have just reported. Okay, so nothing to worry about there. When we start looking at the Admiral, we've got normalization right out of the gate already. So this particular series has already cleaned itself up, and you can see that we've got that nice 8% trajectory. 2021, obviously a little bit light because we had pulled up some of that demand in the COVID crisis. The Admiral portfolio itself, as I'm showing here with the red box on the price earnings chart, was actually able to grow earnings. So we're going to trough out a little bit in 2021 and then resume trajectory in 2022 and 2023. And this is exactly what we would expect. ECP Admiral just continues to plug away, and this growth trajectory remains intact. Notice just that rock solid underlying earnings stream that just protects you from those recessionary troughs and those rapid sell-offs that we get with black swan type events. Notice the beta on this portfolio as well, a sub 0.7. As with all of the Admiral family of core equity portfolios, that's the ECP 75 stock, the Admiral 30, as well as the Dividend Aristocrats portfolio that we're going to talk about here in a minute. The betas are so low that in order to maintain performance in up markets, we need to supplement with macro tilts. And we're going to talk about those as well and look at those revisions here in just a minute. But it's the use of the macro tilts that allow us to get that beta of 0.68 up so that we can continue performance and continue to add alpha in up markets because we're obviously protected in down markets. But it's really the characteristics of this bulletproof underlying earnings trajectory on a trailing 4 quarters basis that makes this portfolio so unique. Okay. So again, doing the same thing that we did with the ECP 75 stock. We look at the ECP Admiral 30. These are the 30 names that can literally continue to thrive and flourish even when the U.S. economy is shut down in a black swan event such as a pandemic like COVID. And I want everyone to see how we troughed here on May 31st as well with earnings. We didn't trough that bad at all. And then you can see that acceleration and literally every single month, almost without fail, we continue to experience an increase in the estimate revision, which is, again, another characteristic of the ECP Admiral and any of the ECP family of portfolios. Specifically this time of year, again, we're paying attention more to the top panel, which is the FY1 period. When we start talking about FY2, again, a little bit more sporadic here because these estimates aren't as thorough. We don't have as many contributors because they literally just rolled in from FY3. Okay. We look at the Dividend Aristocrats 25 stock portfolio. Again, these are going to be the 25 highest yielding names out of the core 75. And you can see that nice yield up here of 2.65% on average. And as you would expect, if we're reinvesting, if we're not reinvesting as much into the business and we're paying out in terms of earnings, the growth is going to be just a touch less. And it is, but just stable and solid as a rock. And you can see that here. So no underlying issues here with the earnings certain Dividend Aristocrat portfolio. Again, much more earnings stable, earnings certain than you would get out of the S&P 500 Dividend Aristocrats, the Noble portfolio. You're not going to experience the type of sell-off that you would holding a Noble type portfolio or a Noble ETF. Okay. So again, that characteristic of, bottoming out here at the bottom of May of 2020 during the COVID crisis, and that forecast for FY1 continuing to rise. You can see that here. And again, a little bit sporadic again on FY2. I expect these to clean up. They certainly will as we move throughout the year. Okay. What we're going to do now is we're going to focus on the macro tilts. So those are the 6 stocks that we use alongside of the ECP portfolio And we utilize these tilts from a macro perspective to capture approximately 20% of the weight of the S&P 500 with as few stocks as possible that we also expect to continue to deliver us alpha on the upside. Okay. So these are your Apples, your Amazon, your Facebook, your Google, your Adobe, and your Microsoft. Okay. And what I want everyone to see here, obviously, is that beta of 107. So it gives us that additional alpha in up markets. I want you also to see that this thing has now been literally sitting flat for 6 months. And there's a lot of reasons for that. The primary reason is obviously the interest rate expectations and the inflationary expectations, along with what's going on with the cyclical rotation. But we do get these periods from time to time where things get flat. The interesting thing is, though, is that once we go flat, notice that growth was a little bit flat here as well. We don't have growth flat here. So we're flat during a period where growth is actually accelerating. 17% into 2021, 23% in aggregate. So again, using the composite facility inside the research system. If you do have the research system, all you need to do is type in ZECTPE, and you already have this composite and you can access it. Just go to charts, price and earnings, and you can replicate this view. And again, spectacular growth. These are the tilts. And what's even more impressive is to take a look at the EPS estimate revisions in aggregate for the 6 stocks. So again, this is a composite. We can look at financial statements. We can look at estimate revisions. We can look at whatever we want. And we see the same exact thing, right? We see earnings troughing here for FY1, May, June in this case of last year. And we've absolutely increased literally 25%. We've gone from $20 in aggregate to now 25, 27 for F1. So that's a tremendous increase in the estimate revision. And what's most impressive is that a lot of it has come in just since, the end of February. We've literally gone from 23 to 25, 27. So let's take a look at this for some of the individual members, right? So if we take a look at Apple, right, some of the things that I look at with the tilt and monitor is, how these companies are doing with regards to estimate revisions. We already know that these are the bellwethers of the S&P 500, but I like to make sure that they're still going to be delivering on the growth. And we can see with Apple here, certainly upward revision for both F1 and F2, nice solid revision. Okay. Amazon as well, very impressive. Literally just coming in on February 28th. We can see March 8th here as well, confirmation, and going from 45 to 49. It's nice and impressive. Facebook, similar scenario here, right? Trading at really, really inexpensive valuations. Notice the Zacks rank here as well. As I'm moving through these slides, it is visible. 1048 to 1128, 1276 to 1357 here. Revisions remain positive for Facebook. Google revisions, obviously positive. Google's actually had some upward price momentum. The rest of the group has literally been sitting flat for 6 months. And Google's probably the one that's gone up the most in that time. Google, I think, sat flat for a good portion of the COVID crisis. So it's just playing a little bit of catch up now. But at any rate, FY1 and FY2 consensus estimate revision positive here, contributing to that overall aggregate increase in the forecast. So doing a little bit of forensic work here and bumping through the 6 stocks specifically. Not much has changed with Adobe. I didn't even put it in the slide deck, but certainly Microsoft 673 to 734, they just continue executing. And it's looking really nice. So just some brief takeaways here from today's strategy webinar. Again, from a forecast EPS growth perspective, and again, just now starting the whole process of going through and orientating myself again. I do this on a regular basis, but this time it's for the actual changes that, if any, are going to take place in Q1 of this year. I'll have those out by the end of this month. Starting with this EPS growth perspective on a forecast basis. So all three ECP core portfolios are behaving exactly as expected during this recovery period. The ECP Macro Tilt Portfolio, like I mentioned, those 6 stocks have literally been sitting flat in aggregate over 6 months with EPS estimates on the rise. And, my message to everyone with regard to these macro tilts is because they're literally 20% of the S&P 500, you never want to take your eye off these guys. The fact that they've been sitting for 6 months is like a rattlesnake in the grass. If you're not careful, they will come to haunt you. You will get steamrolled by these guys. They will move. It just is a matter of time before rates settle down and investors remember, oh, there's something other than a cyclical rotation. I better get some more exposure to these critical growth names that are such a large part of the S&P 500. Price and earnings stability, it's definitely remaining intact for forecast EPS trends. And this is all as expected. At this point, from a forecast perspective, it's literally steady as she goes. I'm liking what I'm seeing. So there'll be more to come on the Q1 2020 membership review as I continue to work through the process. But that's about it for this week. If you found this video helpful, please hit the like button below and be sure to subscribe for future videos. If you have any questions or requests, please leave a comment below or feel free to email me at tnyland@zacks.com. You can also follow me on social media. I'm on LinkedIn and my Twitter handle is @TimNyland. If you're interested in getting started with advisor tools or the research system, or you're looking to upgrade your current subscription, please contact our world-class support at advisortools@zacks.com and zrs@zacks.com. I have this slide deck available for anyone who wants it. Just go ahead and either email me directly or any of these email addresses that you see on your screen, and we'll get it out to you right away. Thank you very much for watching, and I'll talk to you next week.